If you're on Social Security and you haven't looked closely at your bank deposit this year, you could be losing money right now without even knowing it. There are 3 changes affecting your money in 2026 that most seniors have not noticed. One of them could put an extra $6,000 back in your pocket. One of them is already quietly taking money out of your check every single month. And one of them could get you a letter demanding money back if you don't handle it the right way. Stick with me, because by the end of this video, you'll know exactly what these 3 changes are, whether they apply to you, and what to do about each one before the year gets away from you. Why this matters right now. Here's the thing. A lot of these updates went into effect quietly earlier in the year. No big press conference, no flashy announcement, just a line item buried in an SSA notice or a tax form most people skim past. And August is actually a critical checkpoint. We're past the halfway point of the year. If you're going to fix a mistake, adjust your withholding, or avoid an overpayment before the year closes out, this is the window to do it. Wait until December and some of these things become much harder to correct. So let's go through each one. And stay with me for the second one especially, because it's the one that quietly affects almost every single person watching this video, even if you think it doesn't apply to you. Money change number 1, the new senior tax deduction. Let's start with the good news, because there is good news here. As part of a new tax law, people age 65 and older can now claim an additional deduction of up to $6,000 per person on their federal taxes. If you're married and both you and your spouse are 65 or older, that could mean up to $12,000 in additional deductions between you. Here's why this matters so much. For years, seniors have asked the same question. Is there any way to reduce the tax bite on my Social Security income? For a lot of people, especially those with modest retirement income, this new deduction can significantly lower or even fully eliminate the federal tax owed on their Social Security benefits. Let's say you're a single retiree bringing in Social Security plus a modest pension. In past years, part of that income might have been taxable. With this new deduction added on top of the existing standard deduction for seniors, a good portion of your taxable income simply disappears on paper. That can mean a smaller tax bill, or in some cases, no federal tax owed at all on your benefits. Now here's the part most people miss. This deduction isn't unlimited, and it isn't automatic for everyone. It phases out for higher income taxpayers, and it's currently set up as a temporary provision covering a specific range of tax years, not a permanent fixture. That means the window to take advantage of it is limited, and if your income changes from year to year, whether you qualify can change too. So what should you actually do? Don't wait until next spring to think about this. Talk to a tax preparer or use IRS resources now, in the middle of the year, to see how this deduction affects your withholding or your estimated payments. If you've been having taxes withheld from your Social Security check based on old assumptions, you might be withholding more than you actually need to. That's your money sitting with the government instead of in your account. There's another detail worth mentioning here. This deduction stacks on top of the regular standard deduction that seniors already receive, and it doesn't require you to itemize anything. You don't need receipts, you don't need to track expenses throughout the year. If you meet the age requirement and your income falls within the eligible range, it's simply applied when you file. That's part of why so many people miss it. It sounds like it should be complicated, so they assume it doesn't apply to them, and they never bother checking. Think about a couple who has been filing their taxes the same way for the last 15 years. Nothing about their paperwork process has changed, so nothing prompts them to ask whether something new might apply. They file the way they always have, using the same deductions they've always used, and they leave money on the table simply because nobody told them the rules shifted under their feet. That's not a hypothetical. That's happening to real people right now, and it could be happening to you. We'll come back to why timing matters so much in a moment, but first, let's talk about the one that's already quietly costing people money. Money change number 2, Medicare premiums eating into your check. This is the one that catches people off guard every single year, and 2026 is no exception. Medicare Part B premiums increased this year, and that increase is deducted directly from your Social Security check before it even reaches your bank account. The standard monthly premium moved up significantly compared to last year, which for many retirees translated into a noticeably bigger bite out of their monthly benefit. Here's what most people don't realize. Your Social Security payment did go up this year because of the annual cost of living adjustment, But if you're enrolled in Medicare Part B, some of that increase got absorbed by the higher premium before you ever saw it. So on paper, your benefit went up. In your actual bank account, the increase might have felt a lot smaller, or in some cases, barely noticeable at all. Let's say you're receiving a typical retirement benefit. The cost of living increase added some extra dollars to your monthly payment. But the Part B premium increase happened at nearly the same time, quietly canceling out a meaningful chunk of that raise. If you didn't compare your new deposit amount to last year's deposit amount, line by line, you might not have even noticed. And here's the detail that trips people up the most. If your income is above certain thresholds, you don't pay the standard premium at all. You pay more, sometimes significantly more, through what's called an income-related monthly adjustment. This is based on your tax return from 2 years earlier, which means a good income year in the past can raise your premium today, even if your income has since gone down. Before you assume this doesn't apply to you, check your actual deposit amount against your official COLA notice. If there's a gap between what you expected and what you received, the Part B premium is almost always the reason. What should you do? If you think you're paying a higher income-adjusted premium because of a one-time event in the past, like a home sale or a retirement account withdrawal, you may be able to request a reconsideration with Social Security. That's a real process, and a lot of retirees don't know it exists. Here's another piece that surprises people. Medicare Part B isn't the only premium that can shift your net check. If you carry a Part D prescription drug plan, higher income beneficiaries can also see an income-related adjustment added there too. It's a smaller amount individually, but combined with the Part B adjustment, it can add up to a real difference in your monthly deposit. This is exactly why comparing your official notice to your actual bank deposit matters so much. The numbers on paper and the number that lands in your account are not always telling the same story. Let's walk through a quick example. Suppose you're a retiree who sold some investments a couple of years ago to help a family member or cover a major expense. That single financial decision, even though it happened once, can follow you into your premium calculation 2 years later. You might open your bank statement this year, see a smaller deposit than you expected, and have no idea why. The answer is usually sitting in a notice you may have skimmed past months ago. Don't overlook this part. If you believe your premium is based on outdated or unusually high income from a one-time event, that reconsideration request can genuinely lower what you're paying going forward. It's not automatic, nobody calls you to offer it, you have to know to ask. Now let's move to the third change, and this is the one with the most serious consequences if you get it wrong. Money change number 3, the earnings limit if you're still working. If you fully retired and you're not earning any wages, this next part still matters because chances are you know someone it does apply to. If you're receiving Social Security retirement benefits, but you haven't yet reached your full retirement age and you're still working, even part-time or seasonally, there's a limit to how much you can earn before Social Security starts withholding part of your benefit. For 2026, if you're under full retirement age for the entire year, that limit sits at just over $24,000 annually. Go over that limit, and Social Security deducts $1 from your benefit for every $2 you earn above it. If you're reaching full retirement age sometime during the year, the limit is higher, just over $65,000, and the withholding rule is a little more forgiving, at $1 withheld for every $3 earned above the limit. Here's a real-world example. Imagine you retired early, started collecting benefits, and then picked up a part-time seasonal job over the summer to bring in some extra income. That's incredibly common. But if you don't report your estimated earnings to Social Security, or if you underestimate how much you'll actually make by year's end, you could end up getting paid too much throughout the year. And Social Security will eventually catch that mismatch. When that happens, you don't just lose future benefits gradually. You can receive an overpayment notice asking you to pay back the excess, sometimes as a lump sum. That letter arrives at the worst possible time, usually months after you've already spent the money, assuming it was yours to keep. This is exactly why August matters so much for this particular issue. You still have several months left in the year to estimate your total earnings accurately and update Social Security if your income picture has changed. Wait until January of next year, and you're reacting to a problem instead of preventing one. There is one important exception worth mentioning. Once you reach your full retirement age, this earnings limit disappears completely. You can earn any amount from work and it will not reduce your Social Security benefit at all. So if you're getting close to that milestone, This concern has an expiration date, and it's worth marking on your calendar. There's also a common mistake worth calling out here. Some people assume the earnings limit applies to all income, including things like pension payments, investment income, or withdrawals from a retirement account. It doesn't. This rule is specifically about wages from a job or net income from self-employment. If your extra income this year is coming from a pension or an investment account instead of a paycheck, this particular limit simply doesn't apply to you. That distinction alone clears up a lot of unnecessary worry for a lot of retirees. And if you do go over the limit, it isn't necessarily a permanent loss. Any benefits withheld because of excess earnings aren't gone forever. Once you reach full retirement age, Social Security recalculates your benefit going forward to account for the months that were withheld, which can result in a slightly higher monthly payment afterward. That doesn't mean it's fine to ignore the reporting requirement. Getting an unexpected overpayment letter is still stressful, and correcting your estimate now is far easier than untangling it later. But it does mean this particular mistake isn't the kind of thing that should keep you up at night if you catch it early. Pulling it all together. So let's bring these three together, because they all connect to the same bigger picture: what actually lands in your bank account each month. The new senior tax deduction can put more money back in your pocket at tax time, but only if you understand it and plan around it now, instead of waiting until filing season. The Medicare Part B premium increase is quietly reducing the real value of your cost of living raise, and most people don't notice until they compare their deposits side by side. And the earnings limit rule can turn a helpful part-time job into an unexpected overpayment notice if you're not tracking your income carefully throughout the year. None of these are rumors. None of these are scare tactics. They're simply changes that are already in effect, sitting quietly in the background of your finances, waiting for you to either take advantage of them or get caught off guard by them. What you should do next. Here's your simple action plan. First, pull up your most recent Social Security deposit and compare it to your official COLA notice from earlier this year. If there's a gap, check whether Medicare premiums explain it. Second, if you're 65 or older, ask a tax professional whether the new senior deduction changes what you should be withholding or paying in estimated taxes before the year ends. And third, if you're working while collecting benefits before full retirement age, do the math on your expected earnings now, not in December, so there are no surprises. None of this requires panic. It just requires a few minutes of attention at the right time. And right now, in the middle of the year, is that time. Have you noticed any of these three changes show up in your own payments this year? Let us know in the comments, and let us know what state you're watching from, because these rules can play out a little differently depending on where you live and what other benefits you're receiving. If this video helped clear up some confusion about your money this year, do us a favor and hit that like button, subscribe if you haven't already, and turn on notifications so you don't miss the next update. Social Security and Medicare rules change more often than most people realize, and staying a step ahead is the best way to protect the benefits you've worked your whole life to earn. Thanks for watching, and we'll see you in the next one.